Welcome back to the channel where we decode the headlines and read between the lines. It's the first week of July and it's been a wild one. We've got a major trade deal with Vietnam, a surprisingly strong jobs report, Fed rate speculation, and another round of high-profile layoffs. But don't let the record highs fool you. This market is riding more on hope than on hard data. Okay, let's unpack what really happened this week and what it means for the months ahead. Okay, so on July 2nd, the US announced a new trade deal with Vietnam. 20% tariff on Vietnamese imports. That's down from the 46% Trump imposed back in April. And the US, they don't pay tariffs on exports to Vietnam at all. It's all part of a bigger effort to shift supply chains away from China. And Wall Street jumped on it. The Nasdaq gained 0.94%. The S&P climbed almost 0.5%. Apple, Nvidia, Tesla, all up. Nike, big bounce. Because a lot of its goods come from Vietnam. Now here's the thing though. Investors are hungry for good news. Any news that signals global trade isn't breaking. But let's not get carried away. This is a temporary fix. It's not a transformation. China's watching, tensions could rise again, and if they do, these gains could vanish. The deal gave tech a jolt, but it's a sugar rush. It's not a meal. Next, the June jobs report. The US added 147,000 jobs, way more than forecasted 110,000. Unemployment dropped from 4.2 to 4.1%. But dig deeper. Most gains were in healthcare and state and local government. Federal government jobs down 7,000. Strip out the public sector and the private economy only added 74,000 jobs. That's the weakest showing since October. Temporary help services lost jobs. Average weekly hours also down. That tells us that businesses are being cautious, pulling back just a little but not laying off yet. And wages, they are up 3.7% year over year, steady, not spiking. Markets reacted fast. S&P and Nasdaq both hit record highs, but bond yields jumped too. The 10-year Treasury rose to 4.35%. Why? Because this jobs report delays rate cuts. The chance of a cut in July, just 4.7% now. September is still in play, just under 70%, but slipping. All in all, the labor market is strong, but softening around the edges. The Fed has zero urgency to cut. October, maybe December, now look more realistic for a move. And finally, layoffs. Big ones. Microsoft just announced 9,000 job cuts, 4% of its global workforce. Meta, Morgan Stanley, BP, Adidas, Bumble, all trimming headcount. A World Economic Forum report says 40% of companies expect to shrink their workforce in the next 5 years, mostly because of AI. Markets barely blinked. Why? Because investors see this as strategy, not panic. Companies are tightening up, shifting toward AI, cutting bloat, getting efficient. But here's what to watch. If layoffs spread to consumer-facing industries, or if they hit demand, that's when markets might flinch. Two big risks. One, high-wage layoffs could slow wage growth and consumer spending. Two, if this turns into a broader trend, it stops looking like discipline and starts looking like distress. Right now, layoffs are seen as forward-thinking, but that narrative can flip fast, from confidence to caution. So here's the recap. A trade deal with Vietnam, short-term win, long-term uncertain. A strong jobs report but mixed under the surface. Rate cuts still coming, but not in July. Maybe not even September. We don't know. Layoffs treated as smart now, but that could change quickly. Yes, markets are hitting records. But underneath the celebration is a fragile foundation. The Fed is watching, inflation's still sticky, and confidence can turn on a dime. Thank you very much for watching. If you like this video, please do subscribe, and let's build the bridges and not burn them. Goodbye.